but on the API you can. So we had like just kind of a prompt like that saying like, hey, you're a quant researcher doing this. And so I didn't do any of the setup for creating these numbers. But what these numbers are is it would say, okay, I want a certain number of outputs. I want you to rate from us on a scale of 1 to 5, how much the Federal Reserve is talking about these factors. So there's a bunch of them there. So short rate sentiment, long rate sentiment, surprise. Surprise is like, did anything happen they didn't expect? Phase, like economic phase, like the Ray Dalio economic phases, credit conditions, credit conditions outlook. So there's a bunch of these. So if you go in here, all these like 0 through 9 are trials, and then they took an average. So the PW average is the average of the trials.
Okay.
What's the regular and the LP?
LP is log probs. Log probability. So
Long probability.
log probability. So we use the ChatGPT API. If how it works is it takes a series of possible responses and then it outputs the one with the highest log probability. So that's a way to tell like how sure was it of this thing that it outputted.
Okay.
So the log probs I didn't use because they're not super relevant, and because we're taking an average, I think that kind of eliminates that. But the other thing here is consumer demand percentage. So this percentage is what percent averaged of the Federal Reserve statement talked about consumer demand. And that, I don't know, it doesn't seem the most relevant. The problems with this data are, they decided, God knows why, to do a scale of 1 to 5, but like just 1, 2, 3, 4, 5.
So now like place.
Maybe.
Nothing in between.
No, I think maybe they do 0.5. Maybe 1.5, 2.5, but that's it. So like you get a lot of, the graph has a lot of hard jumps because of that.
Yeah.
It's really hard to do a regression for something like that. But if you take it out over a long enough time period, you could theoretically be able to make some kind of progress. So Tyler and I did a bunch of work on adding in some real life variables.
Where did you get this data from?
This data was output from the model.
Not. And what deductions that you came out with that, like the steps that you were telling about the long probability and all, these were the factors you tested the report on?
No, so the log probability was basically, think about it of like, so let's say you're trying to make a decision and you're not really sure of what to say, but you have 3 options. The log probability is what percentage it was sure that it's crazy. Yeah. Yeah, cool. But the problem is it only gives you the highest one. Like it doesn't give you the distribution. I wish it did do that, but it only gives you the probability. So the percentage for like consumer credit percentage doesn't really seem very helpful. And like you'll see a lot of these, it's just like 4, 4, 4, 3, 3, 4, 4, 4, because it can only do it in big discrete increments, which I really don't like. We also we tried a bunch of different things to see what it could predict. And if you guys want to, I feel like you guys want to get into this, you could get very into this. But Tyler and I couldn't find any predictive power at all, essentially. You can find explanatory power, which is probably helpful. Like I found some pretty good explanatory power, but
I think this problem,
what?
yeah,
So the to do
if you
is
find
here,
it,
Yeah,
Yeah.
if you find it, you're like,
you got,
you
yeah.
have a firm of
You
your
don't need
own.
anything. You're
Right.
just selling the stuff.
So we have these analysis codes. So I have a whole another long Excel spreadsheet on this, but these are just like simple comparison correlations on these things. That's just a initial guess. And none of them are too high, but like the problem is, so you guys know what autocorrelation is? Okay, so when you have autocorrelation, it ramps up the correlation coefficient artificially. And so when you account for that with other things, it kind of shows that the correlation is not very high. So we have this analysis correlation, and we have a bunch of other data in here, like gold prices, S&P prices, trying to correlate anything to these outputs. And so what I did most recently is. Oh, where's the ball? So basically, this is the paper I did recently of predictive power of this data, trying to find something that it was correlated to. So basically, my plan was I wanted to do multivariate regression with a bunch of different variables and then try to include these variables in addition and see what difference it makes. So there's a way of testing for statistical significance called Granger causality. And basically the way Granger causality works is it runs a multivariate regression with the data in question, and then it just runs a multivariate regression with only previous values of the data that you're testing, essentially. So does the variable that you're testing help predict the Y variable more than previous values of the Y variable alone? And that's kind of a prerequisite to be useful in regression at all. So, and then when you test for that, you get a p-value, you know, like p-value. Yeah. So, since I had a ton of these, I had to account for the p-value being low, or else you're gonna basically overfit. And so these are my top p-values, and as you can see, all of them are real world factors. So this is Treasury bill 90-day monthly yield. And then you'll see the lag column. So I also did a bunch of lags to see like, okay, if let's say you're predicting, you want to know how much does the current variable predict the future? But like, what is the future? Is the future 1 month? Is the future 1 week? Is the future a year?
Yeah.
So you have to test all of those individual different lags. So a bunch of these, you'll see repeated variables, but that's because they're just at different lags.
So how long is it? Like, how long are those lags?
7 years or 7
No, they're months.
months?
7 months.
Yeah. And then difference is, Mikhail, the sponsor, wanted us to try percent changes. But the problem is that they're just huge discrete values, so the percent changes don't really work so well, because they're always like 20 or 10. But I did try percent changes of the Y variables to try to predict that, so that's when you see underscore diff. It's just the difference tattoos. It's what? So like the difference thing is when it's just like it's like calculating return. So if you have a long period of prices, it's usually more useful in financial data to have a long vector of returns. Because returns are more stable than price. And so it helps in some predictive models. So the difference is just trying to do that, see if that helps. And so it also makes sense that like, you see the 90-day monthly yield is right next to the difference 90-day monthly yield. Like it makes sense that they'll be very similarly correlated. But the problem is that all of the top p values are not model output variables. So that's, they're not model output variables. They're just real world factors. So, and then this is to try to predict, I think gold prices. So this is T+3, so 3 months in the future. Oh no, this is, we're trying to predict return of treasury bills. This is just, I just did it for one variable to test it. And then if they were statistically significant at all, I was just going to make a function that could just do this for 100 different variables.
Hello?
Hello, Pierre, just give us 1 minute,
Sorry.
4 minutes.
Okay.
Hello, Patrick. Okay, so I wait.
Yeah, you can stay on, don't worry about it.
Yeah, okay.
So for 6 months, you can see that it's still all real world data. For 12 months, same thing. And so then I was like, okay, let's try doing the multivariate regression with and without the real world, with and without the model data. So if you look at this model, you've got the actual prices and the actual T-bill returns in blue and the predicted T-bill returns in orange. And when you look at that, from first glance, it seems really good. But this is kind of a trap in time series forecasting a lot of the time because it's shifted forward. And so you get an R squared value that's really high, but it's just off enough. It's shifted like just enough that it's useless to predict something 1 month in the future. So when you look at this graph, it's really nice, but then that hit rate, which is just, does it accurately predict the next step going up or down, is 51%. So it's a problem. Which is not good, which is just random. So then we tried 3 months out, and then as you can see, it shifts a little, so kind of the same problem. Again, R squared of 0.9, but we test the hit rate, and it comes out to be 52%, which is not so good. And then we do the same. Oh, and then he wants difference. This difference is, I just included because he asked for it. It's not actually very helpful. Like I talked about before, the difference variables are always like huge jumps. So that's not very easy. But with 3 months, the R squared drops again. And then when you exclude the model data, it goes down by a tiny bit, but it's such a tiny bit that it's not really significant. And then I did, just in case, a T+12.
That was 92% there?
It's not 92% accurate, it just,
Random.
it fits the curve. It's not quite a percent, it's they're very highly correlated. So when one moves up, the other will move up. But for predictive power, the 52% is the number that you should probably be looking at. But for 52%, it either goes up or it goes down. So it's 50-50, it's just purely guessing. And so this is 6 months out. And so that's it. That for this in particular, the model was no better. And that was I'd say the most deep dive we've done into predictive modeling, but I'm sure if you wanted to put a ton of time into it, you could try with lots of different other things. You could try with different real world variables. The reason I picked treasury returns was because there's a high emphasis on predicting inflation because the Federal Reserve is inflation and jobs. So I'm sure this could actually be really cool. So there's a big question right now about whether or not the Federal Reserve numbers that are coming out are accurate or useful. Like underemployment is always very, very underreported. Like I saw some like private data companies is saying like unemployment is actually like 8.1%, but the Federal Reserve is putting it at 4.0. So this is the report I did was on inflation, but if you guys wanted to go into like a jobs report, that would be pretty interesting if you got a number that was like higher than the actual Federal Reserve report. And you could maybe claim them like, oh, with this model that we're using, we're able to explain the current terrible job conditions better than the Federal Reserve's numbers can. Because the way the Federal Reserve reports unemployment is they literally just call like 10,000 people and they ask them if they have a job. That's it. So it's
And they don't reply.
No.
Kobe, thank you very much. We have our notes so far.
What's up, what?
Can you?
Yeah.
Pierre, can you hear us?
Yes, I can hear you.
Okay.
Hello.
Hello,
How are you?
so you're joining us, in the classroom, in the MFE classroom at Lehigh University in Bethlehem, Pennsylvania. And
Great.
where are you?
I'm in Sifour, near Toulon, or near Marseille, in France.
So far away from here. Anyway, so you know the team already, you already
Yes.
themselves on LinkedIn. You could see them in the back.
I know Avinder, I know Akshat,
Action is on.
Edgar, yes.
the
Oh, yeah, okay. I have various videos and the whole classroom, right? Okay.
Okay, you see, so maybe we could start, because, we don't have we don't have another call after, so we've got a little bit back. So maybe, can you start with your idea, Edgar, and then, where the team is looking to take it, and this, I guess what they want from you is, because you led many things, as we know, but, in addition to the structured finance at BNP Paribas globally, so maybe, Edgar, could you, what's your ideas, and then I guess a team with action, kind
Yeah,
of say
so-
where you guys wanna take this, and I guess where Pierre can help.
Yeah, can you hear me from here, or should I unmute my mic?
No, don't mute, this microphone,
Oh,
so if you
okay.
speak loud, you should be able to hear.
Okay, perfect. So I'll just introduce myself really briefly. My name's Edgar. I am a fifth year student. I graduated from finance and currently completing a dual major in industrial and systems engineering as part of the honors program at Lehigh. And just to give you like a bit of context, I worked in the structured products field over the last summer, and I grew really interested working around and playing with tools similar to what we thought of. And we were trying to come up with a tool that could basically create another price perspective into the mark-to-market value of structured notes. I know this is a bit of a challenge in the way that the structured products work and in the dilemma of what is a correct price, which there could be different answers to. But just, I think it'd be interesting to kind of like go through the process and work with people to see if we can make something transparent and versatile that would work for either investors, issuers, and banks themselves.
Action, so what do you guys think?
So, you can hear me, right?
Just.
Yes, yes.
Okay. My name is Akshat Kumar. I'm a student here at Lehigh University, working with the Master's in Financial Engineering program. I have a specialization in data science, mathematics, and computer science. And I'm also interested in this project. I'm interested in it from more the quantitative aspect in terms of how we take the actual mechanics of structured products, abstract them out into mathematical models, and then with those mathematical models, create predictive models for pricing and essentially make a end-to-end quantitative system in order to deal with these structured products, because they can be, slightly obscure compared to more traditional investments like bonds or stocks. So that's kind of my interest in this project.
Hi, I'm Arvinder. I'm a MFA student here at Lehigh. I graduated from physics, and I have some experience with mathematical modeling. And that's the project that I'll be handling, like designing the payoff function and like what the end product would look like and how to generalize the product to the number of underlines that we're going to handle. So yeah, that will be my part, and yeah, I'm really interested in the project and really excited to work.
Did you hear that, Pierre?
Yes, I heard that. So I understand the three of us, the three of you are working on the same project? Or each one has, same project, okay. And the aim of the project is to develop a model to model structured products, right?
Correct. Yes.
Okay. And how do we proceed now? Are you going to explain your model, to describe your model, or
Maybe,
ask questions, or what?
yeah, maybe you could give them a little bit of real world of what you handle on your side, so somehow we need to, connect what we're working on and what's really done, so make sure we're doing something. Well,
Okay. So I studied economics and statistics, and I worked most of my professional life at BNP Paribas. I had many jobs. I counted 8 jobs, so I will not describe all the jobs. It was about equity investment, credit, and structured credit. In terms of structured credit, I was in charge of, and this comes close to your area of interest. I was in charge of managing the portfolio of subprime assets of the bank during the subprime crisis, 2007 to 2011. So we used many models to simulate the future performance of ABS bonds, RMBS, CMBS. Those models were purchased on the shelf, but they were very complex to use. I had a team of quants who developed these models, make them work, and I decide then someone had to decide on the parameters in order to inject into these models to lead to a value. We did this for our own portfolio. We did this for the portfolio of Fortis Bank, which was a Belgian bank, which BNP Paribas acquired in 2009, I think. And it was a big project which led to value the value of to value the equity of Fortis and to decide upon the price which we would put on those shares in order to acquire that bank. This is what I can say about my experience. Now, how do we proceed next?
Okay, wonderful. So one thing that really sticks out to me there, and one point that I really see our work coinciding, is that you bring up how you look at structured credit, and you look at that in order to do portfolio management for banks and financial institutions based off your work in analyzing structured credit. And your expertise seems like it's mainly in handling things that come from, mortgages, right? Mortgage-backed securities and things of that nature.
Yeah.
Now, today, what we can see increasingly in the finance world is that banks and financial institutions are increasingly using structured products and understanding the risks and valuations associated with structured products in order to do their portfolio management. So in fact, the work we're doing could really coincide in that regard. Once we have a consistent valuation model for these structured products, which we can of course go over with you and work with you on that, we can then understand how banks can start to manage their portfolios by including these structured products in order to manage things like risk, right? Because structured products pretty famous help banks manage risk. So that's definitely how I can see, our expertise and our goals sort of coinciding.
Yeah, absolutely. I think you're right. Yeah. Structured products are used by portfolio managers. I was also global head of portfolio management for BNP Paribas. So we use structured products in order to manage risk, to manage regulatory capital as well, but essentially risk, default risk. Using those valuation methods was very useful in order to assess the provisions that we had to make on a 10 billion euro portfolio of subprime assets in 2008. So there are many use of those valuation methods. They can be quite complex. Now, which kind of products have you managed to value through your models? Have you developed a model for each various kinds of products?
Right now, our project is completely in its infancy. We're just starting off. So we're building this from the ground up with you. But we do have experimentation regarding buffered return notes, and we have been doing exploration into auto-callable notes. So we have valuation models for that. And I think one big thing that we could do is you discussed the way that valuation models are used in order to do portfolio management. Perhaps once we come back with our valuation models for different kinds of structured products, you can give us a direction and kind of some feedback in terms of how we can combine and use these models to design portfolios and add structured products to portfolios.
Yeah. Well, I think the second option is the one I would prefer to understand where you stand and what is your level of expertise and of development in this regard.
Yes. So
Then I can react to this because I will not be able to describe in detail the kind of structured product that we use in the past to manage these various portfolios of the bank, but I think I can react. I can have a second look at what you are doing. Is it what we should do, Patrick?
yeah, and that's exactly what we're looking for. So in terms of where we are exactly right now, we have two quantitative models that study the value of buffered return notes. So we have one that's Monte Carlo based, and we have one that is more pure stochastic calculus. So we have two models that study how buffered return notes behave, and we're currently upgrading those models and looking into experimenting with these models to understand the relationship between the sentiment surrounding the underlier of a buffered return note and the way we should value it and what its value will be at the time.
Excuse me, could you repeat the term, the description of these notes?
Buffered
Total return.
buffered.
Sorry, I can't understand. I can't hear.
BFN, buffered return notes.
Offered return notes.
Correct.
I'm not used to this term. So you said offered. The first name is offered.
Auto callable notes. So
Auto callable.
Yeah. Edward will write it back as well.
First you said offered return note, and then you say auto callable notes.
Yes.
What do you mean? The auto callable notes applies to offered return notes?
Repeat that?
I included them in the chat.
Yeah, very chat.
But there are two separate structure types that we've been looking into. And I think something that I wanted to point out as well is that we also want to consider like other structure types in the future, which are all part of the market linked investment structured notes umbrella. But to kind of like focus and start off, we thought that looking at one specific structure type, which in this case is buffer structured notes due to its how it's built and how it's put together versus auto callable notes and the models that we had in from our experience. Just going one by one and then try to encompass a different type of structures by the end of our project, I think would be just overall objective, but for the moment, just going one by one in a sort of ladder way, we thought we could be using or implementing a good approach into pricing them.
Yep. So, yeah, so just kind of right now, what we have is quantitative models for the first kind that we have discussed, buffered return notes. That's what we have at this moment. What we want, we want to look at each different kind of structured product and develop a valuation model for those. Once we have that, this is where we want to start studying how do they get included within portfolios and how do they help manage risk and return once they're within those portfolios.
Okay, I got it. So will you start with describing these methods that you have developed, or at which stage do you stand in the development of your model?
So right now, for buffered return notes, we already have two prototypical quantitative models. So we already have two prototypes for evaluating them.
The Monte Carlo and the pure stochastic model, yeah?
Correct.
Okay.
So do you want me to maybe go into detail on how each of those models behaves currently?
Yes, I'd like to, yes.
Okay, wonderful. I'll do that then. So like I said, we have two models. One is the purely stochastic model, and one is the Monte Carlo, right? The Monte
Yeah.
Carlo perhaps a little bit easier to understand, so I'll begin there. What we do is we use geometric Brownian motion in order to study the behavior of the underlier. Right?
Geometric what, sorry?
Brownian motion, GBM,
Geometric?
Brownian motion.
I can't get the second word.
I'll put it in the chat. Geometric Brownian motion.
Oh, Brownian, okay,
Yes. Brownian, yep.
okay.
So we use geometric Brownian motion to study the movement and behavior of the underlier. From there, we know what the payoff graph looks like for our structured buffer return node.
Yeah.
So there, what I do is, since I have geometric Brownian motion for the underlier, I can get a probability distribution for the performance of the underlier.
Mhm.
From there, what I do is I use, since the payoff function is really just a function that is acting on the underlier, I use a push forward measure in order to get the probability distribution of my returns. Once I have the probability distribution of returns, I can now give you mean and variance and Sharpe ratio and all sorts of things. Right? So that's how we deal with the stochastic model. The Monte Carlo simulation is we begin in the same place. We have the geometric Brownian motion, but there, instead of using a push forward measure and instead of getting a probability distribution, what we do is, just using the stochastic variable, we will run a certain number of tests, right? Like some millions of tests. And then we will average out the result after applying the payoff function. And then once we take that average, we also have a good estimate of the value of the buffer return node. Now, we also have sentiment in these models that's being factored in, but this is the core of the model. Everything we're building is on top of this.
Okay. Now, could you explain more about the offered return nodes? What is the structure of those nodes? Which is Patrick, I'm sorry, this is something I did not run into.
We can send you resources in terms of explaining exactly how buffer autocallable nodes work. So we'll explain that on this call, and we'll absolutely send you resources once the call is over in order to right? But Edgar, I think you can give a simple explanation for buffer return nodes.
So actually maybe a good way to kind of like start out is just going over like how the payoff works. Usually in the market linked investment deals for structured nodes, whether it is autocallable, buffer, or barrier, these are all just terms on the hedging strategies. So a buffered return node, for example, could be shorting puts to be able to provide a certain level of protection when an underlier is performing below the initial fixing, or what is usually called like that, which is the stock price at the time where the structured product is issued, right? So if, let's say, I have an underlier performing at negative 20%, which is 20% below the stock price at the initial fixing, then a specific buffer of 20% would provide me that protection of a payoff of 0. So I would get my initial face value when the stock is underperforming, right? If that stock continues underperforming below that 20%, then you start to incur the loss or the participation on the downside. And so what that allows you to do is that you can lose up to 1 minus the buffer of your money in the initial place, right? So what that means is that if the stock has gone negative 100% or has gone from, let's say, 100 to 0, then I'm just going to lose 80, not 100, because that buffer represents that protection of 20% for this specific case.
Okay. So is it like a call up? Is it like a sell option,
Similar, so
a put option with a buffer, or with a, I don't know, how will you compare it with a put or call?
yes, so in terms of connecting the options, I think the easiest way to understand it is through the payoff graph, right?
Mhm.
In the payoff graph for a sell or a put,
Okay.
what you have is a monotonically increasing function, right? It reaches a certain point, then it caps. Here, what if we have a function that is linear, it's still made up of lines, but it's no longer just a simple monotonically increasing and then caps. The
Yeah.
buffer gives certain protection. So if I'm above zero, a certain amount above zero, then get the return of the underlier. Then above the cap, I flatten out. I will only, so up to 20%, I get whatever the underlier has. Past 20%, I only get 20%. It caps, right?
Okay. It's like the combination of, is it not a combination of a call and a put?
Yes,
Yeah.
it's like if you combine many options together, you will get a graph. Yep.
Okay, all right.
Mhm.
Okay.
So that's how buffered return node works.
Mm-hmm.
And the reason why we call it buffered is it gives a certain protection, right? Like generally what it does is, okay, like I can give one example. The first 10% loss, you will not feel. So if it goes to minus 10%,
Yeah.
you're not affected. But past that, you will now start feeling the loss. And in the same way, past above 0%, you will get your returns up to, let's say, 20%, but then you're capped. If it underlier
Okay.
gives 10%, you get 20.
Okay,
So
I see. And the underlying, the underlier is what, a stock price or any
it could be many things. It can be a stock, it could be a bond, it could be anything.
anything? Okay. Now, modelizing this is quite easy, but the question is, if you want to assess, you wish to assess the risk related to this instrument, or is this instrument only a way to hedge the risk of a portfolio of something else?
Well, you can buy these investments on their own, but you can also use them to hedge the risk of a portfolio.
Okay. So if you buy them on their own, the question now is how to assess the risk of the underlier, the probability of the underlier going up or down.
Right, right. And its relationship to then the payoff graph, and then what the expected return looks like for the product as a whole.
Uh-huh, uh-huh.
And it's basically the combination of those two things. What do we think the underlier is going to do? And then now you also have the payoff graph, so that will change the return that you will end up getting based on what the underlier does.
If you take a practical example, which kind of underlayer would you use?
If you take a practical example, I would give an example with a stock.
The SPY, just example.
Yeah, you can give the spot.
What I've seen usually happen is for the private banking side is they use indexes more often. Or sometimes they even, I've seen deals that perhaps use stocks that people have are bullish. So if they're expecting it to go up by a large amount.
Okay. Indices, well, so stock price indices, right?
Yeah.
Uh-huh. Okay. Now, well, it seems to me that the modelization of this instrument is quite easy. It's not complex. What is complex is to seize the risks of the underlier. No?
Well, yes, exactly, because the only thing that this adds on top of the underlying is the payoff graph, right? But that's what we want to understand is the relationship between those two things.
Okay. So, what is your well? What is your objective? What do you need to do in order to reach your objective? You said you have two objectives. You want to model and value the risk, and then see what is the use of such instrument in the framework of a portfolio management strategy, right? So the first stage is to assess the behavior of this kind of instrument in the future, no? Is it right? Is it that what you mean? What you wish to reach?
Yes, yes, that's the first step, the valuation step.
Valuation, that means the risk, the valuation. Okay. So the valuation is based on the behavior of the instrument and on the behavior of the underlier. So you have to have a kind of probability law for the underlier. Then you can translate it into the valuation of the instrument. But do you have any idea in order to value the risk on the underlier? Have you worked on this?
Yes, so that was one of the things we were discussing. One of the ideas that I was discussing before is that, okay, if you want to understand risk, then in risk, you look at, okay, what is the variance of the probability distribution for the returns, right?
Mhm.
So use geometric Brownian motion to get the distribution for the underlier. I can use a push forward measure to get the probability distribution for the returns of the structured product. And then
Yeah.
that would give me a measure of risk.
Yeah, yeah.
Mhm.
So it's a bit of it's kind of garbage in, garbage out. The risk on the underlier decides on the risk on the instrument. Now, if you take a stock price index, like I don't know, Nasdaq or well, you have what can you use? You have, of course, you can assess. We can use kind of Gaussian law or assume that this index follows um, a typical statistical law, probability law, with constrained by the average, the standard deviation, this kind of stuff. But there is no law, there is no obvious law for the underliers. You can, or you can do statistics, retroactive statistics on the history of the evolution of this index in order to assess its characteristics in terms of variance and average, I don't know.
Yeah, the one of the big things here is that the structure of the payoff function does quite affect the risk of the asset. Because if, let's say, I'm providing protection up until the first 10% loss, then one of the big questions becomes that, okay, to what degree, based on the actual performance of that asset and the history of that asset, to what degree does that actually give me protection, right? What probability is there that we would actually experience that 10% loss? And how does the offset structure of that specific structured product change what we should expect in the return, right? And same kind of logic on the cap. So actually, the payoff graph does end up quite changing what the probability distribution looks like.
Yeah. But I come back to the underlier. The underlier does not follow an obvious probability law. The history is quite hectic. It depends on so many parameters. It's not a smooth law of probability. So what you could do is just an idea. You could apply your instruments to the 5 or 10 last years of behavior of the stock market, and then you would have you would end up, you could measure the risk of your instruments in terms of gain or losses, the probability distribution of the value of this instrument over time, over a long period of time. That's the main thing I would see.
Yeah, so the main way that we're doing this is we begin with the geometric Brownian motion model, which obviously has the drift and volatility parameters. And then what we do is we set those parameters by looking at some historical data. And then once we have the geometric Brownian motion model, we use the forward Kolmogorov equation, right, Fokker plane, in order to then get evolving probability distribution. From there, I use the push forward measure in order to understand the value of the structured product and how that value changes over time.
Yeah. What do you mean by push forward model? What do you mean?
In statistics, whenever you're doing a change of basis, like where you have a probability distribution on a certain variable, and then you're applying a function on that variable. What is the probability distribution of the output of that function?
Yeah, okay.
Yeah.
So to translate the probability profile of the underlayer into probability profile of the function of the instrument.
Correct.
Question you have. Question is also which kind of time horizon you have to measure the performance of your instrument. Is it on a daily basis, day-to-day basis? Is it on a monthly basis? Do you want to assess the risk on a yearly basis or on a monthly basis, as an example?
Generally, these products mature, they take either between 6 to 18 months for to mature. So it would probably be on that kind of time scale, but we also want to understand the mark to market, right? Like if it were sold today or what its value is today. So in that way, we would also be tracking the value on kind of a daily basis, right? So mark to market, we're studying every day, but the maturity happens between 6 and 18 months.
Yeah.
Yeah, I think it's an interesting point of conversation that since there is not a really well-established secondary market for market-linked investments and these types of structured notes, there's at the moment actually a really high demand for, and this I kind of like hinted towards at the beginning of what is, or how can I get a snapshot of the value of my specific investment today, and how much is that worth really, given the different probabilities at the day of creation, that at a random day tomorrow, let's say, at an observation date, and in order for people to be able to make decisions in terms of like, oh, maybe the issuers are expecting to roll over all these products and a massive call is going to happen, so then they can upsell to their clients. Or maybe the clients are actually wanting to get out of the investment because their interpretation of the value is actually lower than they were expecting. And someone may find that expected payoff to be greater than what someone else is actually expecting. So then maybe they can be interested in purchasing that at a random point in time to a specific investor that might be looking to get out of it.
Understand that most important for you, well, your objective is to measure a value, mark to model or mark to market. It's not only a question of risk; it's a question of value. So
correct, both value and risk. And in order to include it in a portfolio, you need an understanding of both value and risk.
Sorry.
For the inclusion within a portfolio, you need a good understanding of both value and risk, which is.
Okay, so this is the state of your work. You're just beginning. Are you beginning this work, or have you thought further about the way you would measure this value?
Yes, yes. So the mathematical models I'm describing to you, we've already written down those mathematical models and we've already turned those mathematical models into code. Currently, it's a command line interface that we can use for prototyping and for testing. So we've already written down the mathematical models and we've already turned that model into code.
Okay. So the next step is to measure a value, a reasonable value, which could be used for portfolio management purposes or for even for accounting purposes.
Yeah. Correct.
Mhm.
And one thing I was wondering is there any data that we could get from your end in terms of this kind of testing?
That I'm not really. That I'm not. Um, I retired some time ago, you know.
Oh,
I'm not. I'm not. I'm beginning to become an old retiree. So I don't have files about the work I did. I don't have access to the works of the bank, etc. I just have an understanding of those subjects and an experience. Um,
well, yes. So
yeah, I need to think. I need to think a bit about what I could propose you to move further in this reflection.
absolutely, that would be wonderful.
What would be really helpful, if, like, if you could describe the structure of the product that we are supposed to price, so that we can choose our mathematical model accordingly to that product. So
Yeah,
you can give some description of the product, that would be good.
this I would like to have. Yes. Mhm. Then I have to think. This.
Okay, wonderful.
I have to refresh my mind about the way we did measure the value of our product. Actually, what we did with these subprime products is that we had models, simulation models of the future performance of those products, and we had a central scenario. We designed a central scenario. Was not We did not use stochastics models. We used a central scenario. Central loss scenario on the underliers. And then we valued this scenario based on discount rates, which reflected the rating, the rating of the notes. And well, it was part of my job to decide that for a single A, the discount rate should be 1%. For triple B, it should be 2%. I don't know. And then we discounted those future values, which was, the risk was taken into account through the discount rate, which was the market interest rate for this kind of instruments, or this kind of risk.
That makes
So
sense.
we relied a lot on rating agencies,
Yeah.
but not only on rating agencies, because we made under assumptions on the default evolution of the underlying portfolio. A set of assumptions, but was far from stochastics. It was kind of linear, and our value added was to know how the model worked, how the product worked, and to assess the price that we would put on the product through the discount rate. The discount rate was our choice, but discount rate was a market discount rate. So, I'm a bit far, my experience is a bit far, is not similar to what you are trying to do. That means that I need to think it over a bit in order to see where what I could add to this project. Was specifically where RMBS were not offered return notes. With different. I worked with different assets, but as I've seen many things in the bank over my 25 years, I will try to be positive or to be useful. I have some ideas about the way you could move forward. I think that's the step I would propose to you, to send me whatever description you have of the notes, of the objective of your work also, so that I can assist you in deciding on a methodology.
And yeah, again, it totally makes sense, right? The securities you were studying, your substrata was, mortgage-backed securities, which all came with a rating, and that was how you understand the risk, right? Is it in double A's and B's and C, right? So that comes with the rating. Basically, what we're doing with the stochastic calculus is it's a kind of rating, but it's different from that sense. But I think you could bring us a really unique perspective in terms of understanding how this valuing is done and how these portfolios are made. So I definitely think that, after we think things over a little bit more, that unique perspective could be very valuable to us.
Let's try. I'm happy to do that.
Thanks, Pierre.
But I cannot sell you something I don't have in my hands. I have to.
No, but the way these projects work, usually the students go out, they're gonna go back and they're gonna work on their own. And then they're gonna come back to say, this is what we have. And then you look at it and you say, okay, and you, I guess it's perspective that they're looking for.
Yes, perspective, exactly.
Because I don't want them to work on very complex things that people don't use and are not really that helpful, because then what they do, usually they go out when they interview, right? They go and they take this and they say, this is what I worked on. And I want them, when they do that, they could bring your experience, say, oh yeah, I know this is, right? So it's rooted on something real, basically.
Mhm.
Not a pure research paper.
Patrick, you remember when we worked together on CLOs, as an example? Did we value CLOs? We did not really value CLOs, no?
Well, we use that model, right?
We assessed risks, default risk, then ratings. We worked with default risk, expected loss, and ratings based on the volatility of losses. But we did not value our CLO notes that we owned in the bank, right, Patrick?
Well, we mark to model.
Mark to model.
Rim teriyaki or Rim, she designed the model.
Okay.
So,
Okay.
but anyway, let's see what they come up with.
Yeah. Okay, and we can discuss further, Patrick, to us to refresh my memory.
Yeah, but you're gonna have to come back to speed. Yes, that's for sure.
Okay.
Okay.
Let's do that, and I will follow up. I will tell you when I'm ready to continue this discussion, this interesting discussion. And you seem to be very motivated guys.
Yeah,
Thanks.
I like this contact.
Every 2 weeks at that time, we'll meet you. You'll have something.
Okay.
Okay.
Every 2 weeks. Yes. Okay. All right.
5 p.m.
Thank you, guys.
Thank you. Thank you.
Have a good day.
Speed.
Hello? Everybody's
Hey
joining.
everyone, how are we?
The background looks real. Hold on. So, so everyone is joining in. Okay, so let's not waste any time. So I have Zuber over and talk to us about what he does, because believe it or not, or what we do. A lot of what we do has quite a bit of what you're doing, your business is doing. Maybe you could explain, Zuber, what is Orchid?
Yeah, so until very recently, I was CEO of this company called Orchid, where what we do is pretty much automate model creation. A lot of what you guys will be doing if you go end up becoming Quant is research and model creation. What that process looks like is specifically what we are automating pretty much looks like finding research papers. A lot of you will end up looking at academic papers, identifying the training rules within those papers, which is one of the hardest things to do. Creating a first version of the model that you find on the papers, running that, keep iterating on that until you have something that's optimal with the firm's thesis that you're working with. And that's pretty much what we did at Orchid, to the extent of I think at our peak we had around $9 billion under advice. So this is directly teams that were using the platform. But yeah, that's pretty much what we do, and I think it's super relevant to what you guys will end up doing once you graduate.
Any question for Zuber? In terms of, I know some of you are now doing some of that stuff, so. And Zuber, you're in London, right?
I am in London, yes.
But you said something very quick at the beginning, that at the beginning you were, are you still in charge of Orchid? Something happened? Are you?
So I am no longer at Orchid, but that is because I am working on something else at the moment, which is to be revealed.
Gotcha, very interesting. Guys, question for us.
Yeah, I have a question. Sorry, so you said that basically what you guys were doing is creating agents that would automate the sort of the process from taking your research paper and then turning those into like actual codified like rules for trading strategies. Is that essentially what you guys did?
Yeah, that's a part of it. It didn't have to be research papers. I mean, it can just be straight from whatever you want, but yeah, pretty much.
So it was kind of a way to streamline just streamline the process from different strategies to actual like codified trading rules.
Exactly. I think the best use case was pretty much filtering through the rubbish, because there's a lot of research papers out there that don't really quantify too much. So just kind of figuring out where to begin, going from 0 to 1, and then the actual quants take it from 1 to 10.
Yeah, interesting.
Anyone else?
Maybe you can ask a question, Professor.
Yeah, I think on purpose, because I realized that I'm sorry, so what does this guy do exactly? Is he, so how was it for you to build this business? I mean, how did you, because I think you had a job at a hedge fund, you know what? I mean, how did you?
Yeah, so I think it was an interesting process going from working at a fund to then building a business. I think it started off, as I think we've discussed this before, but at the start we weren't trying to build a SaaS company, right? We were trying to build a hedge fund. We had some backing from the Kuwait Investment Authority on that. We eventually didn't end up getting approved by the FCA, which is, I guess, our version of the SEC. And as a result, we kind of pivoted because we built a lot of internally for our own internal modeling and our internal research, and we didn't want it to go to waste. We were like, fine, I'm sure there's other funds out there that kind of need this stuff. So On that though, my particular role was as CEO, so I didn't have, I guess, much input on the actual code on our platform, but I was leading more the business side of it.
So I assume then that like majority of clients for you then are institutional. Like this is probably a pretty yeah.
Yes. Yeah, only institutional clients. We don't touch retail or even professional investors.
Yeah. So what is your background in?
Sure. Yeah. So I studied economics at the London School of Economics. My background after that, prior to that, is that I was working as a quant analyst and a equity fund in London for around a year and a half before I started Orchid.
I'm curious about the models that you use. Did you was it something you designed in-house or you outsourced?
So we didn't outsource any of the development. Everything was done in-house. In terms of the exact models, I'm presuming you're talking about, in this particular case, just language models that we were using.
Yes.
So some of them was just off-the-shelf language models, of things like Gemini, things like GPT. Other ones were post-trained by us. And then there were some models that we pretty much trained from scratch with a firm called Millennium. It's a pretty big hedge fund, so we work with them to train some of our models.
Okay. And that leads to my next question, which is what were like the measures that you had in place to mitigate like the risk of probably like a model not doing or not performing
Sure.
as expected or extracting?
Yeah. I think it depended on the exact task that we were looking at, just because we had so many different language models doing so many different things. The 3 or 4 key metrics that we really focused on was risk management, mitigating look-ahead bias, reducing hallucination of financial data, along those sorts, and then lastly, just the quality of output, which again, quality of code. Funny thing about language models, some of them are really good at coding these days, but they're not very good when it comes to, I guess, financial engineering, simply because the data that they've been trained on is so heavily skewed towards software engineering that you have to kind of go back and post-train them quite a lot to get them up to speed.
Okay. And just out of curiosity, like the whole process from start to